Hi everyone! In the previous episode, we have outlined what an economic cycle looks like and how these data can help you achieve your investment goals. Now, the biggest questions you have right now must be, when and what should you invest in? Economic cycle investing is basically adjusting your financial exposures based on the current economic conditions. To answer those questions, let's first go through the most common financial assets that you must have heard of before. First, equity. Equity includes stocks, bonds, and ETFs. Fixed income includes government bonds, junk bonds, and emerging market bonds. And then, cash. Cash includes your bank savings and foreign exchange. The last one is commodities, like crude oil, gold, and crops. Our investing strategy is to increase or decrease your holdings of each or all of these financial assets based on the macro economy. Before you buy any of them, you need to understand how they work, their risk, yields, and the rate of returns. Stocks and bonds are tools for business to attain funds. When you buy their stocks, you become a shareholder. When you buy bonds, you become their creditor. The rate of return of stocks rises as the economy expands. Shareholders gain profits as the company's corporate profits increase. Bonds have rates of yield. When you buy bonds, you will receive interest on a regular basis and will be repaid when the bond matures. The return from bonds is lower but stabler than stocks. For example, a highly rated US government bond with lower risks and returns than stocks is seen as a good hedge for investors. Cash is also a form of investment. As the saying goes, cash is king. Despite any changes in the economy, you receive interest that incurred from your bank savings. But keep in mind that although cash is safe to have, inflation can reduce the value of your savings. As of Forex, the US dollar and Japanese yen are generally thought of as safe havens. The most popular commodities are crude and gold. Crude oil is essential in every aspect of our daily lives. Its price not only has a strong impact on the prices of other raw materials. Oil price is also closely connected with inflation. And inflation pretty much controls the monetary policy of all central banks in the world. In contrast, gold is inflation-proof and generally seen as a store of value. So the best time to invest in gold is when the economy shrinks or when the economic growth starts to slow down or to recover from the bottom. Now, we will talk about how to manage these four categories of investment at which phase. During growth, consumption and profits are growing with mild inflation. It's the best time to invest in risk assets such as stocks and commodities that could generate high returns. As growth slows down, stock market and oil market could see some corrections. It's better to reduce exposures in risk assets and to increase holdings of hedges like bond and cash. In times of an economic recession, hedge assets like bond, gold, the US dollar, and Japanese yen are usually the right choices. Inflation usually shrinks into deflation in times like this. The costs of holding cash are lower, so you can have more cash in your portfolio until the economy rebounds. As the economy gradually recovers from rock bottom, it's time to enter the financial market again. You can gradually buy in stocks that have good fundamentals and low risks, or stock ETFs, bond ETFs, and balanced ETFs. Let's do a quick recap. At growth, profits are good, demand's high. You can invest in the stock market and buy oil futures. As economic growth slows down, you should gradually reduce holdings of stocks and oil and turn to investment-grade bonds. During recession, stocks are too risky. It's time to increase holdings of bonds, gold, or Japanese yen until the economy begins to improve. Stock and bond prices rise as the economy gets back on track. Demand recovers, so it's time to slowly buy your way into the stock market again. Also, it's time to invest in commodities at their lows. Macro's aim is to educate investors to be responsible for their own investment strategies, and the most important of all, to make higher returns. We focus on observing the big picture, so visit en.macromicro.com to collect all charts you'll need for economic cycle investing. We will continue making more videos on this channel, so don't forget to subscribe,